An order for the purchase or sale of a security is dependent upon the type of security involved. For instance, shares of common stock are usually bought or sold in packages, which are referred to as lots. As a rule, the investors deal with round lots. Round lots of common stock are equal to 100 shares. For preferred stock, round lots can contain as few as 10 shares. If one does not have sufficient funds, it's possible to buy an odd lot, which is a lot containing less than 100 shares. However, the price of the purchase will be higher, as the brokerage office must group odd lots for the formation of round lots, and only after that will they be able to execute the investor's order. The size of the commission on odd lots is also higher. The minimum size for an order of options or futures is 1 contract. A correct order for common stock includes the following information: buy or sell, the name of the security or its symbol, the size of the order, the number of shares for stock or the number of contracts for options or futures, the time limit specification, and the type of order. Before we go any further, let's take a look at some of the information we're going to be dealing with regarding the purchase and sale of securities. Remember that a quote is the highest offer to buy and the lowest offer to sell a given security at a certain moment in the market. When asking for a quote via a quote server on the internet or from a broker, we receive more information than just the quote. As an example, let's look at a quote for the common stock of Intel, and this will be from the Data Broadcasting Corporation server. We'll go through this field by field. The first is the symbol of the security and the market that it's traded in this case NASDAQ. The time of the inquiry. Next, the time of the last trade. It should be noted that most quotations have a 15-minute delay. This characteristic is common for all free-of-charge quoting services on the internet. The quotations, which one might receive from the site of a broker, as a rule, are given in real time. Next is the price of the last trade. Then, the change in price as compared with the closing price of the previous session. Then currency, in this case, US dollars. Percent change, which is the change in price simply expressed as a percentage. Then open, which is the price at the opening of the trade session. Tick, this is the measure of the price change. As a rule, the tick is given for the last several trades. If the trade is at a price higher than that of the previous one, it is said to have an uptick. If the price is lower, it is said to have a downtick. If the price did not change, it's called a zero tick. A very simple example would be that if XYZ stock opened at 74 7/8, and after that the following trades took place, it would look like this. Tick symbols, plus is an uptick, 0 is a zero tick, and negative, or minus sign, is a downtick. Back to our quote. We look at bid, or bid price. This is the price one can currently sell the stock for per share. And ask price is the price one can buy. Bid size. This figure specifies that at the present time there are a certain number of lots, each available for purchase. And the ask size, which shows at the present moment there are 10 lots of 100 shares available for sale. Then day low, or daily low. This is the lowest price the security is traded at to this point during the session. Daily high is the opposite. It's the highest price the security has been traded at so far during this session. Then previous. This is the price at the closing from the previous session. Then volume. This is the number of shares traded since the opening of the most recent session. The 52-week low, which is the lowest price in 1 year. 52-week high is the highest price during 1 year. EPS, which is the earnings per share. The PE ratio. The dividend amount, in this case quarterly. The ex-dividend date. Volatility. The current yield. The number of shares. And the market capitalization. Now, some additional information is given when obtaining quotes on options or futures. We receive a statement about open interest. This is the number of options or futures contracts registered on an exchange at the given time. Now let's get back into orders. First, we're going to look at the time limit specifications of orders. There are the following time limit specifications. Day order. In this case, the broker will try to execute the trade within the current trading session. At the close of the day's session, the order becomes void. Typically, if an order is not accompanied by a time limit specification, the broker will regard the time specification as a day order. The next is good till canceled. In this case, the broker will try to fill this order until the investor cancels it or until the order is filled. And fill or kill. In this case, the broker will attempt to fill this order upon receipt, but if it cannot be filled immediately, it's voided. Now let's look at the types of orders. Depending on the current market price of a security and an investor's wishes, the following types of orders can be placed. Buy market, which is an order to buy a security at the current market price. Sell market, which is an order to sell a security at the current market price. Buy limit, an order in which the investor specifies a price or limit price, which in turn instructs the broker to buy the security up to but not exceeding the limit price. Sell limit, which is an order where the investor specifies a price, limit price, which in turn instructs the broker to sell the security down to but not below the limit price. The next, buy stop, which is an order in which the investor sets a price, stop price, in an attempt to limit potential losses while in a short position. The next, sell stop. The sell stop is the same as the buy stop order, except this is used to cover or limit losses when an investor is holding a long position and the market price goes down. The next, buy stop limit. This order is comprised of two instructions and price levels. 1. The broker makes no purchase until the stop price is met. 2. Once the stop price is met, the broker can purchase the security up to the limit price. And sell stop limit. This is the same as the buy stop limit, except it involves the sale rather than the purchase of the security. Now let's look at an example of these orders. Let's say the current market price for shares of XYZ is $100. The buy market 100. Sell market 100. Buy limit would be 99 and lower. Sell limit could be 101 and higher. Buy stop could be 101 and higher. Sell stop 99 and lower. Buy stop limit within the limits of 101, the stop price, and 102, the limit price. And sell stop limit within the limits of 98, the limit price, and 99, the stop price. Remember, these are only examples, and the numbers would be different in a real situation. Now, let's look at a brief description as to why an investor would use the different orders. First, the buy market. With this, an investor, believing that the price of a given stock will rise, and now is the best time to buy that stock, or take a long position in the case of options, places the buy market order, which allows for a very rapid purchase. The next, sell market. This is similar to the buy market order, save that the investor believes that the price will fall and therefore wants to sell the stock or open a short position as quickly as possible. The next, buy limit. In this case, the investor wants to acquire the stock, but believes that the current market price is overestimated or overvalued, and would be better off waiting a bit in hopes that the price will decrease, presenting more favorable conditions. The next, sell limit. In this, the investor believes that the limit price, which they specified in the order, completely corresponds to its representations about rate of return. Further, they do not think that once the limit price is met, the stock will continue to increase in value. The next, buy stop. This is used if the investor currently holds a short position and is afraid that the shares might move up in price, causing a loss. Not being positive that the situation will definitely move against them, they still wish to insure against possible losses. It is also possible that the investor would have unrealized profit, which they wish to protect, with the help of this order. Next, sell stop. This is the same as the buy stop, save the investor is protecting against drops in prices. Buy stop limit. This order is used when an investor is currently in possession of a short position and is afraid of an unexpected and extremely sharp rise in prices. Thus, not wanting to liquidate this position due to the growth, and because of a long-term belief that the prices will fall, this order is implemented to protect from substantial losses while allowing for some leeway, hoping that the price will come back down. Sell stop limit. This is, of course, the same as the buy stop, with the exception that the investor holds a long position and hopes for prices to eventually move upward while allowing for a current minor drop in price.